The Fed will not give up dark money. When it comes to second quarter U.S. economic growth figures, interpretation is everything. On one hand, the projection of 4.1% second quarter growth is a sign of a surging economy set to grow for years to come. But on the other hand, it is seen as temporary sugar rush created by tax cuts and debt. It's unsustainable in the light of higher tariffs, an escalating trade war that could impact large portions of the economy, and rising federal deficits that put America even deeper in debt. Another data point to determine which of these two camps is most accurate for predicting the future of the U.S. economy is jobs figures. July's jobs report came in with fewer than expected jobs, a gain of 157,000 jobs versus a forecast of 190,000. While that miss in itself may not mean much, since the overall jobless rate dropped to 3.9%, the fact that wages are growing slowly remains a concern. Also concerning is the record amount of household debt. Consumers are using it to spend, and that is partially responsible for that 4.1% GDP growth, as I noted on Fox Business recently. But it's not sustainable. Add it all up and there's considerable reason to believe that the 4.1% growth rate is only temporary. It will not represent the full GDP growth figure over all of 2018, nor will it be the growth figure in 2019 or 2020. Even the Fed admits growth will slacken over the next couple of years. I don't often agree with the Fed. But on this point, I agree with the Fed's forecast for slower growth to come. That outlook presents options for the Fed to create more credit, or what I call dark money, to support the markets, to confront inevitable periods of volatility ahead. Dark money is the number one secret life force of today's rigged financial markets. It drives whole markets up and down. It's the reason for today's financial bubbles. On Wall Street, knowledge of and access to dark money means trillions of dollars per year flowing in and around global stock, bond, and derivatives markets. I learned this firsthand from my career on Wall Street. My first full year working on Wall Street was in 1987. I wasn't talking about dark money or central bank collusion back then. I was just starting out. Eventually, I would uncover how the dark money system works, how it has corrupted our financial system, and encouraged greed to the point of crisis like in 2008. When I moved abroad to create and run the analytics department at Bear Stearns London as Senior Managing Director, I got my first look at how dark money flows and its effects cross borders. The dark money comes from central banks. In essence, central banks print money or electronically fabricate money by buying bonds or stocks. They use other tools like adjusting interest rate policy and currency agreements with other central banks to pump liquidity into the financial system. That dark money goes to the biggest private banks and financial institutions first. From there, it spreads out in seemingly infinite directions, affecting different financial assets in different ways. Yet these dark money flows stretch around the world according to a pattern of power, influence and, of course, wealth for select groups. To be a part of the dark money elite means to have control over many. How elite is a matter of degree. These is not built upon conspiracy theories. To the contrary, alliances make perfect sense and operate publicly. Even better, their exclusive dealings and the consequences that follow are foreseeable, but only if you understand how the system works and follow the dark money flows. It's easy to see how this dark money affects the stock market at a high level, because we can monitor its constant movement. The black line shows you how much dark money the Federal Reserve has printed since 2008. The gray line shows you the S&P 500. They move together. More dark money drives the market higher. Much higher. There are dark money charts from around the world, just like the one I showed you for the Federal Reserve and U.S. stock market. The blue line shows the dark money created by their central bank, the Bank of Japan. The red line shows Japan's major stock index, the Nikkei 225, going up as well. The dark money drove the market much higher over the past 8 years. Again, the blue line shows the dark money created since 2009 by the U.K.'s central bank, the Bank of England. The black line shows how the FTSE 100, their stock index, has followed higher in lockstep. To invest profitably in financial markets, you need to understand the hidden power relationships that drive financial and political events. Ideologies and personal associations among elites are oblivious to political party lines and international boundaries. So is dark money. Needless to say, that's not free market economics. Where do things stand today? The Fed has been raising interest rates since December 2015. And as of last October, it's been reducing its balance sheet, although not as much as they'd have you believe. More on that in a moment. But if markets plummet, the Fed will probably stop tightening or even return to quantitative easing. This week, elite central bankers are having their annual confab at luxurious Jackson Hole, Wyoming. The Federal Reserve Chair invites elite central bankers to wine, dine, and fish. In between the schmoozing, they will talk monetary policy. This year, new Chair Jerome Powell will be the master of ceremonies. He will be addressing the elite group on monetary policy in a changing economy this Friday. The speech title alone casts a broad net. He will certainly discuss the tools available to the Fed when the next downturn occurs. Given that rates are still pretty low, despite 175 basis points of tightening since December 2015, there's not a ton of room to lower them should a recession or crisis happen. The Fed still does not have enough dry powder to fight a recession. One of the items on the agenda at Jackson Hole will also examine the appropriate size of central bank balance sheets, and what they should be used for. Even though the Fed has touted its march to quantitative tightening this year, in reality its balance sheet is barely $200 billion lower than its peak of $4.5 trillion. That's basically a drop in the bucket, not much more than a rounding error. Expect major central banks to end the year, on average, with asset books in total size right where they started. While there will be some minor rate hikes here and there by the Fed, and mild tweaking of massive asset books, the overall story will remain the same. It is worth noting that this Jackson Hole gathering might be more urgent than usual because of the situation in Turkey. You should pay considerable attention to what language they use when discussing contagion amongst emerging markets. The bottom line is, the likely result of this rendezvous will be a bias toward the status quo of dark money. Dark money rules the world, and it could keep the bull market running longer than most people expect, even though the eventual turnaround could be ugly. A bold prediction about one Chinese stock. It's fun to watch my fellow Daily Edge contributors Zach Scheit and Alan Nuckman work. They're the best I've seen at spotting the market's hottest trends. Take for example Alan calling $75 oil months ago when it traded below $50 per barrel. Or Zach when he called the comeback of private equity. After all, who expected a stalling company like Blackstone to rebound the way it has? I'm even more thankful for these calls because it makes my job a whole lot easier. That's because when Zach or Alan get excited about a new trend, that industry is almost certain to see some action soon, which is why I usually make it the first place I look for new recommendations. This week is no different. Alan has been all over this trade war rebound strategy, which is why today I'm going across the Pacific to talk about one of the largest stocks you've probably never heard about that also currently trades at a massive discount. Tencent is China's FANG wrapped into one. Although my expertise is in domestic dividend stocks suitable for investors that are either retired or on their way to retirement, this Chinese juggernaut is trading at such an attractive valuation that I couldn't help but bring it to your attention. Let me introduce you to Tencent Holdings Limited, TSE. This is a $400 billion company that has strategically invested in all of China's hottest technology trends. Online advertising, e-commerce, social media, video games, e-finance, cloud computing, artificial intelligence, self-driving cars, you name it. Tencent is involved in every single one of these and more. Tencent is what's known as an investment holding company, meaning that they make strategic investments in a wide variety of businesses and take a share of the profits when they're made. And they aren't just investing in non-revenue producing startup companies. They're investing in some of the world's largest companies that just aren't given the attention in the Western world that they deserve. For example, Their most popular social media companies WeChat and Tencent QQ combine for over 1.8 billion monthly active users. Their online advertising companies are forecasted to account for 15.5% of China's total 2018 online ad revenue. And their investments in extremely popular video game makers Activision Blizzard and Epic Games, among others, have grown an average of 32% over the last 5 years. And that's before Epic's wildly popular game Fortnite went mainstream. Seriously, if you don't know about Fortnite, ask anybody in the US under 30 years old. Tencent owns 40% of Epic Games, the game's creator. But up until this year, the market had already priced in these runaway successes. He was up 126% in 2017 and up 8-fold over 5 years. Too rich for my blood. But that all changed this year when tariffs became the talk of the financial media. He has declined 20% since Trump enacted his steel and aluminum tariffs in March, as investors are now pricing in the worst-case scenarios for an all-out trade war. But my fellow Daily Edge contributor Alan Nuckman said it best: Chinese stock investors are soon going to realize what American investors have, that the global economy and the Chinese economy are doing well. When they do, they are going to take advantage of this chance to buy fallen stocks at cheap prices. You see, the noise and politics surrounding a trade war could continue for some time, but the strength of both the Chinese and American economies are undeniable. The trade war will soon be settled with pen and paper, and investors will once again focus on this more important factor instead of the flashy trade war headlines in the news. And when this happens, every company that traded lower as misinformed investors panic sold will trade right back to their March highs, Tencent being one of them. The Fed needs to walk back its QT program now. We should have known better, for the gods are eager to punish hubris. On May 17, we forecast the S&P would take a good tumble. 2 weeks later, May 31, we were magnificently, triumphantly correct. The S&P dropped 19 points that day. Inflated by success or deceived by chance, we ventured upon another prediction. Last Friday we said the S&P would drop this Monday, July 2. Our logic was airtight. On all but one occasion when the Federal Reserve cut into its balance sheet this year, the S&P closed lower that day. And this past weekend the Fed dropped over $30 billion from its mammoth $4.30 balance sheet, its largest balance sheet reduction to date. Sure as sugar, the S&P traded lower all day Monday. And we prepared to thump our victorious chest yet again. But by late afternoon the gods moved against us, the market rallied, and the S&P ended the day higher. Thus we depart the prediction business with a 50% win rate or loss rate. We nonetheless look ahead, wiser for the experience. $30 billion last month, the pace of quantitative tightening, QT, quickens to $50 this month. Meantime, the European Central Bank is reducing its quantitative easing, QE, program to $30 billion per month. The math therefore reveals a pending $20 billion liquidity drain, 30 to 50 equals minus 20. Which brings us to this gobsmacking conclusion: coming by way of Phoenix Capital, this is the first time since 2008 that global market monetary policy will be negative. More money will be leaving the system via QT than will be entering it via QE. Is that not a capital fact, that more money will be leaving the system than entering for the first time since 2008? Yet our searches reveal nothing of it in the mainstream financial press. Of its significance Phoenix Capital is clear: the S&P 500 is on very thin ice, they conclude, affirming their demonstrated fondness for capitals. What then is their advice for the Federal Reserve? The Fed needs to walk back its QT program now, or else it is risking a bear market for U.S. stocks. The folks at Phoenix Capital sound lots like Jim Rickards. Jim's been high on his rooftop, hollering the same warnings. Its rate hikes are one thing, says Jim. Mix in QT and the Fed toys with fire. The Fed is giving a weak economy a double dose of tightening in the form of rate hikes and the unprecedented destruction of base money as they unwind QE. It has never been attempted in the 105-year history of the Fed. Quite simply, the Fed has no idea what it is doing. The Fed is over-tightening right now and does not even realize it. But Mr. Jerome Powell gives every indication he'll keep the business going at the projected rate. You can expect 2 additional rate hikes this year, and a full calendar of QT. Unless, of course, stocks fall through the very thin ice upon which they presently skate. How slender is that ice? Bank of America informs us the vast majority of stock purchases this year have been buybacks, corporations buying their own stock. Q1 2018 established a fresh record for buybacks, $242.1 billion. But Q2 buybacks nearly doubled that record amount, to $433.6 billion. What would happen to markets without buybacks? We may soon have an answer, at least in part. Many corporations have entered a buyback blackout period. A blackout period? Many corporations will announce quarterly earnings later this month. And the law forbids buybacks during a 5-week span before they announce these earnings. Thus the market is going without many of the buybacks that have kept it afloat this year. Charles Schwab analyst Jeffrey Kleintop estimated in late June, with the peak in the second quarter earnings reporting season about 5 weeks away, we may be losing the buying support from corporations. Adds Zero Hedge, without buybacks, there will be little buying pressure on stocks. Which is a problem because with just days left until the buyback blackout period, the buyer of last resort for U.S. stocks is about to go on a month-long vacation just as the trade war between the U.S. and China begins. Ah, yes, the trade war. Tariffs on Chinese imports take effect tomorrow. Chinese authorities have pledged immediate counter-tariffs. Meantime, the next QT date is July 31st, when several billion more will drop from the Fed's balance sheet. Buyback blackouts, trade wars, more QT from the Fed, less QE from the ECB. Upon deeper reflection, we may soon be back in the forecasting business.